You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined today by my co-host, John McEwen. It's the 30th of January, 2023, and on this week's episode, we'll be discussing Diageo, Fevertree, Burberry, Ocado, Associated British Foods, and our US company of the week is Intel. John, should we start off with a favourite of the show and one of the members of our fantasy portfolio?
Yes, that's right. And it's one of the ones that is driving performance in the portfolio. And it's Diageo. It's a drinks company, owner of Smirnoff Vodka, Johnny Walker, Tanqueray Gin, and Guinness, but many others as well. They had their interim results out for the 6 months ended 31st of December last week, with net sales up 18.4% to £9.4 billion, with strong organic net sales growth alongside favourable foreign exchange rates with the strengthening of the US dollar. Organic net sales grew 9.4%, with growth in all regions and price mix of 7.6 percentage points, reflecting higher single-digit price contribution to net sales growth, premiumisation, and organic volume growth of 1.8%. And the group point out that growth was enabled by their diversified portfolio with their incredibly strong brands and trend in the industry towards premiumisation. Reported operating profit grew 15.2% to £3.2 billion, with reported operating margin declining by 92 basis points, with organic margin expansion more than offset by exceptional operating items and foreign exchange rates. Organic operating profit grew 9.7% and organic operating margin expanded by 9 basis points, driven by leverage on operating cost, reflecting a disciplined cost management program despite inflation. Price increases and supply productivity savings more than offset the impact of absolute cost inflation on gross margins. In terms of portfolio and premiumisation, growth was delivered by an increased market share in Scotch, tequila and beer. Premium Plus brands contributed 57% of reported net sales and drove 65% of organic net sales growth. Total trade market share grew or held in over 75% of total net sales value in measured markets. And the group continued to optimise the portfolio with acquisitions and disposal. They acquired Mr. Black, a leading Australian premium priced coffee liqueur, and Balcones Distilling, a Texas craft distiller and one of the leading producers of American single malt whiskey. The group also announced an agreement to acquire Dom Papa rum, a super premium dark rum from the Philippines. In terms of disposals, terms were agreed with the disposal of Guinness Cameroon, Archers, and franchising of a portfolio of brands in India. Group have increased organic marketing investment by 6.8%, reflecting strong, consistent investment in their brands, and have invested another £400 million of capex in supply chain, sustainability, digital capabilities, and consumer experiences. Free cash flow came in at £0.8 billion, and operating profit and positive foreign exchange impact were offset by higher year-on-year working capital outflow. The group maintained a strong balance sheet with a leverage ratio of 2.5 times. An interim dividend was announced representing a 5% increase at 30.83 pence per share, and the group expect to complete the remaining £300 million of the current programme to return around £3.5 billion of capital to shareholders in February 2023 and return an additional £500 million in fiscal year 2023. The group expects to deliver on medium-term guidance of consistent organic net sales growth in the range of between 5 and 7% and organic operating profit growth in the range of 6 to 9% between the current financial year and 2025. In terms of valuation, Diageo has a market cap of £77 billion and trades at 20 times forward earnings, which is broadly in line with its 10-year average. It currently yields in the region of 2.5%. I own Diageo and I thought these results were very good, with organic net sales growing 9% and growth across all the regions, along organic volumes also being up by 2%. It has some of the world's best brands, and it's now 36% bigger than it was pre-pandemic. And I do think that trend towards the more premium products and the play on that has worked wonders for Diageo. It does have that potential ahead of it, and we've talked about it before when we look at the market share that it has of overall spirits, and it's surprisingly low. When we looked at it last time, it was about 4%, and the target is to grow that to 6%. And I think you're just surprised that with the portfolio that it has, it's not already higher, and it would be quite conceivable that it would get to 6%. And I see no reason why it wouldn't. I really like it. I think it's not cheap, but certainly when you compare it to some of those companies that operate well in the same industry, Brown-Forman, for example, it's, I'd say, a lot better value than that. And I think it's got better brands, actually. So I like it a lot. I don't think it's ever going to be a company that's going to be cheap to buy. So it's one of those ones that you probably just have to swallow it, and no pun intended. But yeah, I like it a lot. Sam, what are your thoughts?
I like it. I thought the results were very good. I know they had a helping hand with the exchange rate, but even with that excluded, 9.4% sales growth, pretty good. I agree it's got a better portfolio than Brown-Forman. I think we covered that fairly recently, and it does have obviously some very strong brands, but I just felt like Diageo had more household names in the portfolio compared to Brown-Forman. Whether that's the same in the US, I don't know, but over here it certainly felt like that was the case. I think it's a very, very good business. I do think it's quite expensive if it's going to grow at, in the medium term, 5 to 7% a year, and it's 20 times earnings. That is my concern, but it is a very high quality business. And I do agree, it's not a business you often find on the cheap, and it does deliver the results fairly consistently. I really like it. I don't know if I'd buy at this price, but I don't think I'd sell either.
Yeah, it's one of those.
Yeah, it's a tricky one. I think if you bought it, a few years ago, pre-pandemic, and you've got that pandemic bump from it, and you're still holding on, I think you've done quite well. I know it shouldn't make a difference, but I think psychologically it is easier to hold on to it than it would be to buy it at the current levels.
Yeah.
But it is a fantastic business, and I wouldn't bet against it to beat those expectations, because like you say, I think the targets are pretty reasonable.
Yeah, no, I would agree. And it seems to have quite a smart, in terms of the acquisitions it makes, it seems to, make good ones, as well as investing in the strongest brands in its portfolio. And then the ones that aren't so good, like Archers, for example, it's got rid of at a reasonable price.
Should we move on to what could one day be a potential acquisition for them?
Yeah, so with the spirit, you need a mixer.
Absolutely. So Fevertree have come out with their full year trading update for the year ended 31 December 2022, ahead of reporting its preliminary results on the 22nd of March 23. So for the full year, they've said that UK revenue was down 2% to 116.2 million. US revenue was up 23% to 95.6 million. Europe Fevertree branded revenue was up 13% to 89.2 million. Europe total revenue was up 15% to 101 million, and rest of the world was up 18% to 31.5 million, giving total growth of 11% to 344.3 million. They've said that in the UK, although the revenues declined by 2%, the brand continues to gain distribution and market share, remaining the clear leader of the UK mixer category. On-trade UK revenue increased by approximately 28%. However, the widespread industrial action undertaken across the UK rail network in the run-up to Christmas had a notable impact on sales in what is traditionally a very strong trading period. In the off-trade, whilst the mixer category was annualising tough comparators after a very strong period of sales during lockdown, the brand has increased volume share from pre-COVID levels. In addition to our core mixers, we've made significant progress expanding into the adult soft drink category with incremental distribution, very positive initial performance, and an ambitious plan for 2023. In the US, they've said they delivered very good growth, increasing by 23%. However, that's only 13% at constant currency. They said this was despite the impact of industry-wide port congestion and logistics disruption, without which the underlying demand for the brand would have translated to an even stronger sales performance during the year. giving them confidence going into 2023. So they're continuing to ramp up local US production as well as onboarding local glass supply. They also acquired Powell and Mahoney, a US non-carbonated cocktail mixer brand. This acquisition provides Fevertree with a platform to accelerate their entry into this exciting adjacent category in 2023. For the full year, they've said the macroeconomic volatility and uncertainty remains elevated in 2023. However, they remain confident of delivering strong growth, with momentum continuing across all their regions, all their growth regions anyway, especially the US, and a return to growth in their most established market in the UK. As a result, they're introducing revenue guidance of 390 to 405 million, which represents growth of 13 to 18%. Inflationary cost pressures remain, with further double-digit percentage increases across key input costs, including filling fees, ingredients, and packaging. They've said the impact of elevated European energy costs into glass bottle pricing will be material in 2023. Whilst energy pricing has recently reduced, it remains volatile and at least 3 times higher than 2021 levels, impacting both the cost of raw materials and the direct energy cost in glass manufacture. As a glass-led business with approximately 80% of their sales mix in glass bottles, they're particularly exposed to this significant headwind. They now estimate the direct energy component of glass manufacture alone represents an additional £20 million cost in 2023 compared to Q1 of 2022. As a result of the above impacts, they're working to deliver EBITDA in line with 2022 and introduce an EBITDA guidance range of 36 to 42 million for 2023. In terms of the valuation, the business trades at a current PE of 26.2, and according to Refinitiv, a forward PE of 43.5, which compares to an average forward PE of 46.5, and the prospective dividend yield for the next 12 months is 1.4%. However, that would be on heavily reduced earnings due to the cost increases. In terms of the share price as well, the share price is currently £11 a share, and that compares to a 52-week low of £8 and a 52-week high of £22.7, and about 18 months ago it was as high as £25-26. I think this is a business that we both like a lot. It's a brand we both like a lot. The issue we've had is valuation. I think these results are pretty good. I think to have held their own in the UK is fairly decent, and if they're going to be returning to growth, I'm fine with that. I think Fevertree is pretty saturated in the UK, but I think in the year they've had, and we have seen with other businesses trying to crack the US, that they have had similar issues. I know it's a different industry, but ASOS and Boohoo have had very similar issues to what Fevertree are describing in the US. Fevertree have still delivered growth of 13%, excluding the impact of exchange rates, and they've said that that could have been higher, and they expect it to be higher next year. Currently, the US revenue is 95.6 million compared to 116.2 million UK. However, it's still growing. So in a year's time, I would expect the US to probably be their biggest market. And that's a market that could be a lot bigger than the UK. And they are the leader in it because they are having to create the market themselves. I think the valuation is a bit of a red herring because I think there's a lot of things pushing up the cost this year that in the long term will be less of an issue with scale, should come down on its own. For example, once they've ramped up the US production, a lot of those costs over in the US should at least be lower. Energy costs you would expect to start coming back down now. I quite like it. I think for me, I would, that forward PE still concerns me. I probably wouldn't want to take a punt on it at the minute, but I can understand why someone might. I think there's quite a lot of things going for it. John, what do you think about these results and the current valuation?
Yeah, I like it. Well, I think as you said, we both liked it before. I am becoming more and more tempted by it, but I think the valuation probably still does hold me back a little bit. And I think again, I've been burnt with Boohoo more recently, and it's not that I'm definitely wrong on that, but I think it's it's going to take a while for it to play out. So that's probably just steering me away psychologically from it a little bit. But I think, yeah, if it can crack the US, then it's not an expensive company, but that's a big if. And as you say, it's pretty much saturated in the UK. So you're not going to really be delivering the sort of growth that you would need to justify that price. It is all hinged on the US. So I don't know, sitting on the fence a little bit, I think.
Yeah, I mean, yeah, I said already, but you have to take the forward earnings with a pinch of salt. On the current earnings, which by the sounds of it are about to fall off a cliff, they've said EBITDA is going to stay roughly the same, haven't they? But EBITDA isn't earnings. But the current PE ratio is 26.2. But that is going to drop off a cliff, which is why I gave the share price for comparison, because it's quite a bit. Well, it's cheaper than it was. Let's have a look. So it's done 5 years. Yeah, over 5 years, it's down 57%. And let's have a look at the financial, because I think it's probably a much bigger business than it was 5 years ago. Yeah, it is. It's basically doubled in 5 years. But it's down 57%, which shows valuation is important.
Yeah.
I would expect it to do better than a 57% drop in the next 5 years.
Yeah.
Should we move on to another business? A business that has had a bit of a tougher time of it, but now seems to be turning a corner.
Yeah, no, absolutely. So it's one that you've owned, I think, relatively recently, Sam. Burberry, which is, as many people know, famous British fashion designer. They had their third quarter results out last week, with third quarter sales up 1% on a comparable basis to £756 million in the 3 months to the end of December, driven entirely by Europe, Middle East, India and Africa, with Europe performing the most strongly. This was behind the 2% that had been forecast and behind the 7% rise they managed to deliver last year. Meanwhile, in China, or mainland China, I should say, there was a 23% decline with a COVID disruption. Excluding mainland China, comparable store sales actually grew 11%. And then the Americas, which makes up a smaller part of the revenue, fell by 1%. And again, excluding China, the leather goods and accessories did well with positive reception to the new ranges. 15 stores were upgraded to the group's new concept in the quarter, with the total number of refits now totaling 84. Burberry's medium-term targets are unchanged, with high single-digit revenue growth and improving per unit costs. Adverse exchange rate movements are expected to reduce full-year underlying operating profits by £70 million. In terms of valuation, Burberry has a market cap of £9.3 billion and trades at 18.5 times forward earnings, which is broadly in line with its 10-year average, and it yields around 2.7%. I mean, these results were clearly very mixed, and they were dominated by the zero COVID policy in mainland China, hitting the sales badly there. And it does have such a big Chinese exposure. If you exclude that, a lot of positives, and the balance sheet is in a reasonable state, with net debt below the higher end of their target of 0.5 to 1 times EBITDA. And I think also, if you take the long view with the company, the strength of the brand and the large Chinese exposure actually being a positive, with the world's largest population. Appreciate it's not growing as rapidly as it was, but it's definitely not saturated. Given that population and how much they like this brand, it's got, well, I think it's got a huge amount of potential ahead of it. I think when we first started covering the company, I saw it potentially as a little bit more of a drag. But now I think appreciating that potential, I would consider paying 18.5 times forward earnings for that, I think, with that long-term view on it. I don't think it's certainly not a short-term or come to fruition in the very short term, but for that long-term potential. Sam, what are your thoughts on Burberry? You did once own it. Well, was it 2 years ago or so?
Yeah, so I actually haven't owned it, but it's been owned by a friend's portfolio that I've managed. And if I'd had cash in my own portfolio, I probably would have bought it at the time. It was subsequently sold in the Friends portfolio, but it did do pretty well. I think these are all right results. You've got to take them with a pinch of salt, I think, because of what's happened with China. But I think if it weren't for that, the results, if China had been flat, the results would have been pretty good. And I think China will recover. When you look at the business over the last 5 years, revenue is actually basically flat. But I do feel like sort of the last 12, 18 months we've been covering it, we have started to see an uptick in the performance. And I think that's very close to starting to come through now. And were it not for China, I think we would have actually started seeing the sales figure actually starting to increase year on year compared to 5 years ago. I agree with you. I do like it. I think they've done well. I think they've repositioned themselves in the last 5 years, and they've positioned themselves more at the top end rather than doing lots of discounting and stuff. And in the last 12, 18 months, it has started to look like that has been working. So I think this is temporary. I think at 18 times earnings, it's reasonable, but I just don't know if for me, there's other businesses I'd rather own before I get to Burberry. But I think it's a much more attractive business than when we were covering it 2 years ago. And the dividend yield's pretty decent as well. It's nearly 3%. And I think you've got a pretty good chance of some decent capital growth too. So yeah, I do like it.
Okay. Well, it's one to watch. One that we're less sure about on the show, Ocado.
Yeah, so Ocado, it's one that we've covered many times. We did actually touch on it very slightly. We did 2 weeks ago, we did a retailer special. What did we do? Tesco, Sainsbury's and M&S.
Yeah.
All in the same episode. So Ocado have come out with their results. And they've come out with a Q4 and full year trading statement. So we said for Q4, retail revenue was 549 million, which was up 0.3% versus the same quarter last year. That's a result of average orders per week on ocado.com of 382,000, up 1.9% year over year, which reflects 940,000 active customers at the end of Q4, up 12.9% year on year, offset by reducing frequency in customer shopping compared with the pandemic period as customers respond to the cost of living crisis. The average basket value was down 1.3% to £117, as a 7.6% increase in the average selling price per basket item, the lowest price inflation of all major supermarkets, was offset by a 8.3% fall in average items per basket versus the same quarter last year. And they've said for the full year revenue of 2.2 billion was down 3.8% and up approximately 40% from 2019 financial year. Although I don't think the compound rate is that good when you take into consideration the valuation it has traded at over that period. While average orders per week were up 5.8% in the year, reflecting an increase in average customers, and full year average selling prices increased by 4.4%. An unwind of pandemic shopping behaviours accelerated by the onset of the current cost of living crisis resulted in lower basket volumes, down 12.1%, and an average of 6 fewer items per basket, and declining shopping frequency, in turn driving an overall year-on-year decline in revenue. Current headwinds related to inflationary costs, capacity investments to support future growth, and higher marketing costs continue to weigh on profitability for the full year. We expect close to break-even EBITDA in line with guidance. The Christmas trading said we started the 2023 financial year strongly with record Christmas sales up 15% over the 5 days before Christmas, and orders up 13%, including the highest level of orders ever recorded in a single day with more than 72,000. For the key financials, they've said, so the retail revenue 3-year compound annual growth rate was 9.6%, and the average orders per week compound annual growth rate was 5.1%. In terms of the valuation, the business trades at forward price to sales of 2.21, and that compares to a 10-year forward price to sales of 2.89. There are no earnings, and I wouldn't say there's much prospect of earnings in the near future, and there is no potential dividend. In terms of the financials for the past 5 years, revenue has increased from 1.4 billion in 2017 to 2.5 billion in 2021, and earnings per share have increased from a £1.39p loss to a 30p loss. So the earnings have actually, as it's scaled up, it's become less profitable, which isn't great. I think this is a really, really concerning set of results. It's not overly surprising because I think it did massively benefit from COVID, but to have those results and be the retailer that increased prices the least, I think there's a lot of people that were just using it for the pandemic. I don't think it's got any kind of competitive advantage. I think online's a very tough industry. Online grocery is extremely tough, as we've seen with the bigger boys. I mean, you could just, all the numbers are just heading in the wrong direction. I don't think the compound annual growth rate is even that good, considering what it needs to get to justify the valuations it has had. I guess it's nowhere near that now, you could say. So it's actually now trading at £6.85, and it's down. It's still up over 5 years, 32%, but it's down 76% over 2 years. And it was trading at about £27 a share at one point, I think. So it's down like over 80% from the high, but it's still very expensive. I don't really see a scenario where it gets to sustainable profitability. I really, if we've got anyone that's bullish on this stock, please do get in touch, because I don't know why you would buy it. It just seems like it's going to run out of money eventually. John, what are your thoughts?
No, I would agree. For me, it's just not investable, and technology is very interesting, but beyond that, I don't see it doesn't seem to be working for it, even if as it grows as a company.
What do you think of these results compared to the other supermarkets that we looked at the other week?
I mean, I think for me, it was the Tesco's ones, and you've got very decent earnings and a decent dividend with Tesco's too.
Yeah, I mean, these are just the results are just much worse. You can just see it. It just seems to be like a lot of people that were using it, as soon as the price have started to go slightly, and like you've got across, like they've just dropped off.
Yeah,
I don't know why you would be bullish on this stock, even if you really like the technology. I think that doesn't translate into it being an attractive investment.
No.
Should we move on to a business that we have historically liked and another member of the fantasy portfolio?
Yes, that's right. So on to Associated British Foods, probably best known as the owner of Primark, reported revenues rising 16% to £6.7 billion during the 16 weeks to the 7th of January, ignoring the effects of exchange rates, reflecting growth in all business segments, including 15% growth in retail sales and 17% in total food sales. On a like-for-like basis, Primark sales were up 11% with a very strong Christmas period. And the group said that higher unit volumes and sales prices supported this growth, with underlying operating margins lower than last year due to the inflation in the cost of bought-in goods. In the group's sugar division, the UK full-year production expectations have been lowered from 0.9 million tonnes to 0.74 million tonnes, with lower beet sugar yields following recent adverse weather conditions. As such, British Sugar is now expected to be less profitable and lower than previously expected. Going forward, ABF still expects significant growth in full-year sales, but underlying operating profits and earnings per share are expected to be lower than last year, with the inflationary pressures feeding through. The group's digital capability continues to develop, with improved functionality and better customer experience. The new UK website's traffic has increased 85% since last year, with double the average pages viewed per session. The new site has just launched in the Republic of Ireland, to be followed in the coming months by Germany, Spain and the US, with the remaining markets expected by the middle of the calendar year. And they say that they're encouraged by the click and collect trial of children's products in the 25 UK stores, but haven't gone further than that. In terms of valuation, ABF has a market cap of around £14.5 billion and trades at 15 times earnings, which is below its 10-year average of 20. Sorry, that's 15 times forward earnings, below its 10-year average of 20, and it yields 2.5%. I thought these numbers were very good, but slightly flattered by the impact of Omicron last year. And I do think Primark's a company where it is in the market at that sort of the lower end, the value proposition, that it will, I suppose, have more customers trading down, and that will certainly help it. However, it is going to be more squeezed with its narrower margins at the bottom of the market. I do think at 15 times earnings for the type of business that it is, while we do like it is quite a lot, I think. What do you think about that, Sam? Is that so? Would you agree with me there?
I don't know. One thing I do like is the diversification. It does have quite a lot of different business models. It's got a lot of recognisable brands you wouldn't expect to be in there. So as well as Primark, they've got the sugar, and then they've got quite a few food brands. They've got like Kingsmill Bread, Patak's. In terms of the growth, I think the main driver of this business is Primark, really. I think the click and collect trial is encouraging. I think from a retail side, Primark's pretty saturated. I think click and collect, I think that's quite a smart idea. It says that the website, although they are starting to improve it, it's still pretty basic, and you can't do anything other than click and collect. I think that's smart. I think it's when it's at their end of the market, I don't think there's any point even trying delivery because it's just going to lose money. It's the only thing. I think in the past we looked at this, and they were starting to try Primark in the US. If that's not something they're really talking about, that suggests it's not going particularly well. I've not looked at that for like a year or so, but if they were growing in the US, it would be a completely different story. But I think at 15 times earnings, I think it's got some very good brands. I think these are good results. And I think if you look at how it's performed historically, I think it's pretty reasonable for a pretty good business. But I would prefer it with the prospect of US growth. But I don't know how the US side of the business is doing. I've not looked at it for a while.
Yeah, if it were between Primark and Next, for example, at similar valuations.
Well, Next would be a no-brainer, but ABF is probably, it would be up there for best of the rest. There's a few others that I like that we've done, like B&M, Kingfisher, Dunelm. There are some pretty good ones, but I wouldn't. I think Next is in a category of its own, really. I don't think it's. But yeah, but then, part of the reason Next has been so good is because it's been able to leverage its existing network for stuff like click and collect, which is why like over half of its orders come from online. So if Primark are starting to do that, it could be interesting, and it does have a decent yield at 2.5% as well. Is this a trading statement?
I think so. Yeah. Yes, it is. Yeah.
So when the actual results come out, it might be worth having a dig in to see how the US figure, what the US figure actually is, because for me, that does change a lot how much I like it at 15 times earnings, but I do still like it.
Fair enough. Okay, on to our US company of the week, Intel.
Intel, yes, it's a debut on the show. So I wanted to cover this just because I saw a lot of people criticising it on Twitter. That was how it came across my attention. So Intel's been quite a lot of value investors have been getting into Intel the last couple of years, I think. So they've come out with their Q4 and full year results, and revenue for the quarter was down 32% to 14 billion. Gross margin for the quarter was down 14.5 percentage points from 53.6% gross margin to 39.2%. R&D was up 3% to 6.2 billion. Operating margin was down from 24.3% to an 8.1% operating loss. Net income dropped 114% from 4.6 billion to a $700 million loss. Earnings per share has dropped from a $1.13 earnings per share to a 16-cent loss. And for the full year, revenue's down 20% to 63 billion. I might have said million before, it's billion. Gross margin's down from 55.4 to 42.6%. R&D's up 13% to 24.5 billion. Operating margin's down 20.9 percentage points from 24.6% operating margin to 3.7%. And earnings per share is down 60% from $4.86 to $1.94. In terms of the business unit revenue and trends for Q4, client computing group is down 36%. Data center and AI is down 33%. Network and edge is down 1%. Mobileye is up 59%. Accelerated Computing Systems and Graphics is up 1%, and Intel Foundry Services is up 30%. And for the full year, Client Computing Group is down 23%, Data Center and AI is down 15%, Network and Edge is up 11%, Mobileye is up 35%, Accelerated Computing Systems and Graphics is up 8%, and Intel Foundry Services is up 14%. CEO Pat Gelsinger said, despite the economic and market headwinds, we continue to make good progress on our strategic transformation in Q4, including advancing our product roadmap and improving our operational structure and processes to drive efficiencies while delivering at the low end of our guided range. In 2023, we will continue to navigate the short-term challenges while striving to meet our local long-term commitments, including delivering leadership products anchored on open and secure platforms powered by at-scale manufacturing and supercharged by our incredible team. In the fourth quarter, we took steps to right-size the organization and rationalize our investments, prioritizing the areas where we can deliver the highest value for the long term, said David Zinsner, Intel CFO. These actions underpin our cost reduction targets of $3 billion in 2023 and set the stage to achieve $8 billion to $10 billion by the end of 2025. In terms of valuation, the business trades at a PE ratio of 8.63 and has a market cap of $115 billion. And the shares are down at $27.9, and that's down from $60 in December 2020. But the high for the stock was $74.88, which was achieved in June 1st, 2000. So it's not yet recovered from the internet bubble, nor does it look like it's going to anytime soon. I think these results are very concerning. I think it could be quite an interesting case study of, the innovators? Is it the innovators dilemma? That Clayton Christensen book, where it's like the disruptor eventually becomes disrupted because it can't really adapt to the new technologies. Intel is obviously a fantastic business. It used to be anyway. It's not a business I understand massively well, but we have covered NVIDIA a couple of times, and their results don't look anything like this. So in terms of where those sales are going, it looks like a lot of the market share must be being lost to NVIDIA, which must be now at least like 4 or 5 times, maybe even more larger than Intel. It might look cheap now, but if the reason its sales are declining are because its products are inferior to NVIDIA's, and I'm not saying that is the case because I don't understand the products well enough to make a judgment, but if that is the case, then buying it cheap is not going to help you because that market share can keep dropping and dropping and dropping. So I'd be very concerned with this. I think for anyone thinking of buying it just because it's so cheap at an 8.5 PE ratio, and with a forward dividend yield of 5.18%, which probably will get cut at some point, I think if you were to buy this, you'd need to have a pretty good understanding of their products versus NVIDIA's and any other big competitors, like, for example, Taiwan Semiconductor. And you would need to understand why you think what's in the pipeline is worth investing in. Because for me, this would be like investing in a pharmaceutical company. I just don't understand the pipeline. John, your thoughts on these results, the position of Intel and the valuation?
Yeah, no, I would agree with you that analogy comparing it with a pharmaceutical company and the pipeline. It feels like those companies, NVIDIA you mentioned, and I suppose there was that British company that was acquired, ARM, that perhaps did have the edge in terms of the technology, and certainly that future pipeline or that future technology, which makes some of Intel's older generation look, or what they've been building on, look inferior and sort of, I suppose, in some ways obsolete. They're sort of working with the best of the last generation. And even if you say on paper it's not as expensive, I think that it could well be that sort of case of catching a falling knife and getting cut on the way down. I wouldn't pretend to know enough about it, but I'd be very wary of buying Intel just because it looks cheap. That's not to say I go in and jump in and buy NVIDIA, because valuations, I can't remember how high it got when we covered it a couple of years ago, but those shares have pulled back an awful lot. But I think that is just when the market was particularly frothy. If you made me pick, I'd go for NVIDIA, but it's an industry that I don't know much about, but I'd be very, very cautious if I were looking at shares in Intel. That's for sure.
It is an interesting case study as well, because it does just show like how I appreciate this is hardware and a lot of the other companies are like software, but it does show how quickly technology can change, and like an absolute giant can just be within a few years just flat on its arse, really. I mean, like for example, like Microsoft and Apple, it sounds like it's ridiculous to think about, but in like 20-30 years there might be something else instead of the iPhone. People might just not be using it. Like it is unthinkable now, but like at the peak it always is. It is really interesting just to see them, and it'd be interesting to follow actually. But my initial instinct is it's probably cheap for a reason. What would you have anticipated the results and the valuation to be like before we covered it? Is it a stock you'd ever followed?
I was aware of it as one of those sort of fallen giants, and that people have been talking about it as a value play for a long time. But again, not that I knew huge amounts about it. I did own Arm at one point, and that was sort of a broker recommendation at the time. But it was sort of, well, it pretty much was the only sort of British tech company. I know we have Ocado, but and you see Arm in the Internet of Things, in your Android phone. I'm sure you have an Arm chip. In my iPhone, I do, and that was the new technology. SoftBank bought it, and then I think Nvidia tried, but it didn't go through to buy it from SoftBank. But Intel is throughout those years when I did have Arm, it was sort of almost considered last generation, and I haven't seen that sort of narrative change really. I suppose this would kind of confirm that.
Yeah. How long ago was that?
Arm.
No, when you were doing that, and Intel was even at that point seen as best.
That was probably. That was probably getting on for sort of 8 or 9 years ago.
So yeah, so in 8 or 9 years' time, it could be even worse. It's not going to be a quick turnaround, is it? No,
that's right. And again, if you're buying it for the dividend, then that's very vulnerable, especially in troubled companies. And everyone always caveat and say that can be that can change overnight, really.
So of the 6 companies we've covered this week, Diageo, Fevertree, Burberry, Ocado, ABF, and Intel, if you had to buy one, which one would it be?
I go for Diageo. I do own it. But of the rest, probably go for Burberry, I think.
I think I'd probably take a punt on Fevertree, but I would expect to be in for a very bumpy ride.
A bit like the Boohoo.
A bit, well, yeah, very much like Boo.
All of these AIM companies.
Yeah. There is a theme, definitely. They're all trying to crack the US as well, aren't they?
Well, yeah, exactly. That's what's baked into all of those prices.
Well, yeah. Right. Well, I think that's everything in that case.
Yeah. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.